I want to talk for just a minute, about company guidance, because we reference this all the time. It is always part of the story when it's earnings season. But I want to know how you guys use this as stock analysts. And Maddie, I'll just start with you.
Well, I do take management guidance pretty seriously. I think when management sets expectations for the year or beyond that, it's a way for me to gauge what I think the growth of the company could be, and it gives me ways to determine whether management is able to control the destiny of the company and whether they're able to reach goals. What I don't take very seriously, of course, is street guidance you get from analysts and.
Other than us.
Other than us. And, unfortunately, a lot of companies are really good at playing sort of the earnings expectations management game, right? They're great at under-promising and over-delivering on quarterly earnings calls. And so, I don't know what the actual statistics are, but I feel like every time I read an earnings release, and you see the reaction, it's always, well, this company beat by 2 cents or 3 cents, or they beat revenue expectations by $10 million, and it's no longer a surprise. And what is surprising is the stock still reacts positively in general to that, when it's really just all about a company managing expectations.
But Ron, let's just take a new company. If you start digging into a company and you buy the stock, is that management on a tighter leash than a company that you've known for a while and a management team that you've known for a while? Because I'm assuming that it takes a little while to get a sense of how they are when it comes to offering guidance and their vision for the near and long-term future.
That's fair. Some companies, some management teams are better than others at issuing guidance. And some industries lend itself to guidance better. Early stage technology, fast growing companies, it's very hard to nail that, even if you're there every day managing the business. More stable, blue chippy type companies, you can kind of nail that management guidance. You can make it much tighter and not have to make as many revisions as you would with like a high tech company. So I think if you're focusing on valuations and value, for example, like I do, it is helpful to get management's thoughts on where a company is going to be a year from now in terms of cash flow and profits. The quarterly guidance is a little too much for me. It's a little too granular. They constantly have to update it. I would be fine with let's just stick for 1 year out. How does this year look like it's going to shape up? That helps me to inform my models and make a decision about a stock.
Are you the same way, Jason? Would you, if you could wave a magic wand, companies don't give quarterly guidance anymore?
Yeah, I wouldn't have a problem with that. I mean, I tend to always pay attention to what management says they're going to do. So I care more about what management says they're going to do versus what any Wall Street analyst ever imagines they might be able to do. And I always kind of makes me chuckle. Businesses like TripAdvisor, for example, where they don't really offer any guidance other than just maybe a range of sort of sales growth that they're looking at. But we know very well that management there is geared towards sort of 3 and 5 year timelines there. So it makes me chuckle, sort of the audacity of Wall Street to sit there every quarter and say, oh, they missed analyst estimates by this much money, well, those estimates are just arbitrary guesses on your part. And so, yeah, to Ron's point, some companies lend themselves better than others to sort of setting guidance. But for me, really, the important part is that management is doing what they say they're going to do. If that's happening and you see the business continuing to perform fundamentally well, over time, the stock market is going to recognize those good businesses. It's just a matter of us being more patient.
And we have to remember earnings per share numbers, which are, of course, usually the most prominent part of the earnings release. It's what analysts usually zero in on, and whether or not a company missed, or what they're guiding for in terms of EPS. Those numbers can be so manipulated. I don't want to get in the weeds here, but the bottom line is that those numbers can be manipulated in a way that really any company, most companies, especially financial companies or companies that have abilities to do that, can really report almost any number they want in terms of earnings per share. And so just be very aware of that.
Something as simple as share buybacks, for example. They always tout that as being such a great thing. Plenty of statistics out there to prove that companies are pretty bad at it, but that's one very simple way they can reduce that share count and therefore boost earnings per share, which, hey, that looks great quarter you beat the estimates there and everything, but really, is that a sign that your business is performing?
And I'll just wrap it up by saying, if you're a long-term buy and hold type of investor, you can absolutely ignore the quarterly noise. And you probably can even ignore the annual noise, management guidance or analyst guidance, as long as you feel the company is on track and building and growing over time and management is making the right moves. The rest can get a little bit too granular, can be too noisy, can lead you to make poor decisions. Buy and hold good companies that are executing well.
See, you went in a slightly different direction. I thought you were going to say you can ignore the quarterly guidance and you can ignore the annual guidance as long as you keep listening to Motley Fool. I thought that's
what I meant to
I thought
say.
that's where you were going.